The Strategic Diversifier, a comprehensive guide to the iShares MSCI Emerging Markets ex-China ETF, EMXC. As of March 1, 2026, the iShares MSCI Emerging Markets ex-China ETF, ticker EMXC, has transitioned from a niche tactical tool into a core pillar for the modern global investor. For years, emerging markets was a term synonymous with China. However, the economic landscape of 2026 has been defined by a massive great rotation. Investors are increasingly decoupling their capital from the regulatory and geopolitical complexities of the Chinese mainland, opting instead to capture the explosive growth of the other Asia, Latin America, and the Middle East. Following a banner year in 2025 where international stocks outperformed the S&P 500 for the first time in a decade, EMXC has emerged as the primary vehicle for the Sell America, Buy the World trade. With a year-to-date return of 14.5% in early 2026, the fund is currently testing all-time highs. This 1,500-word guide will walk you through the structural shift driving this ETF, its unique portfolio of high-tech giants, and why it is often chosen over the broader, all-in emerging market funds. 1. What is EMXC? The Unbundling of the Global South. EMXC tracks the MSCI Emerging Markets ex-China Index. To understand why this fund exists, you have to look at how the traditional Emerging Markets Index, tracked by funds like EEM, evolved over the last 20 years. By 2021, China had grown so large that it accounted for nearly 40% of the entire index. This meant that if an investor wanted to bet on a young, growing economy like India or a manufacturing hub like Vietnam, they were forced to take a massive, concentrated bet on the Chinese Communist Party's regulatory whims. The deconcentration thesis. EMXC solves this problem by removing China entirely. It provides exposure to 23 of the 24 emerging market countries. In the context of 2026, this is no longer just about avoiding risk, it's about maximizing opportunity. By removing the drag of a slowing Chinese property sector and an aging demographic, EMXC allows the fast-twitch growth of India, Taiwan, and South Korea to shine through. 2. The 2026 portfolio, the Silicon Triangle and beyond. When you buy EMXC in 2026, you aren't just buying a broad market basket, you are buying the physical backbone of the global artificial intelligence AI economy. The Taiwan powerhouse, about 17 to 18% of the fund. The largest holding in the fund is Taiwan Semiconductor Manufacturing Company, TSMC. In March 2026, TSMC is the undisputed king of the foundry world. As global AI spending by giants like Microsoft and Amazon hits a projected $600 billion this year, every single one of those chips passes through TSMC. Because EMXC doesn't hold China, TSMC's weighting is significantly higher than in traditional funds, giving you more bang for your buck on the AI hardware cycle. 2. The South Korean Memory Hub, about 12% of the fund. Following Taiwan is South Korea, led by Samsung Electronics and SK Hynix. These companies are the world leaders in high-bandwidth memory, HBM. In early 2026, Korean chipmakers have seen a massive valuation re-rating as they proved their ability to push through price increases to meet the insatiable demand for AI server memory. 3. The Indian Banking Revolution, about 22 to 25% of the fund. Perhaps the most exciting shift in the 2026 EMXC portfolio is the massive weight of India. Led by HDFC Bank and ICICI Bank, the Indian financial sector is the primary beneficiary of the country's infrastructure decade. As India builds a new Silicon Corridor and hundreds of millions of people move into the middle class, these banks are seeing double-digit loan growth that is unheard of in Western markets. 4. Performance snapshot. the 2025 to 2026 breakout. The performance of EMXC over the last 14 months has been nothing short of historic. The numbers, as of March 1st, 2026. Current price is $88.20, testing the 52-week high of $88.87. 2025 full-year return is 34.9%. 2026 year-to-date return is 14.5%. Assets under management, or AUM, the fund has swelled to $18.04 billion, reflecting a massive influx of institutional capital moving away from China-heavy benchmarks. The dollar tailwind. In early 2026, the US dollar has shown signs of structural weakness, down roughly 10% since January 2025. This has been a supercharger for EMXC because the fund owns stocks in their local currencies, Taiwanese dollar, Korean won, Indian rupee. A weaker US dollar means those international assets are worth more to American investors. 5. Fees and logistics. The cost advantage. One of the most compelling reasons to choose EMXC over the older EEM fund is the cost. EMXC expense ratio is 0.25%. EEM expense ratio is 0.72%. For every $10,000 you invest, EMXC only charges you $25 per year in fees, whereas EEM charges you $72. Over a 20-year horizon, this fee difference can result in a difference of tens of thousands of dollars in your final account balance. BlackRock, the issuer, has intentionally priced EMXC competitively to capture the core holdings of long-term savers. 6. Strategic thesis. Why ex-China? Why is everyone talking about ex-China in 2026? It comes down to 3 pillars. Geopolitical arbitrage. The trade tensions of 2024 and 2025 have solidified a bipolar global economy. By owning EMXC, you are betting on the nations that are neutral or aligned with the Western tech ecosystem. The China Plus One manufacturing shift. Countries like Vietnam, Mexico, and India are the primary beneficiaries of the movement to diversify supply chains. EMXC captures the banks, industrial companies, and utility providers in these countries that are building new factories for Apple, Samsung, and Tesla. Governance transparency. Many investors in 2026 have become fatigued by the disappearing billionaire and sudden tech crackdown headlines coming out of Beijing. The markets in EMXC, specifically Taiwan, Korea, and India, are perceived to have higher levels of regulatory transparency and shareholder protection. 6. Critical risks. What could go wrong? While the momentum is strong, an investment in EMXC carries the inherent volatility of the developing world. Tariff sensitivity. As of late February 2026, renewed talk of universal tariffs from the U.S. administration has caused short-term jitters. Since many companies in EMXC, like TSMC or Samsung, are massive exporters, a global trade war would squeeze their margins. Oil sensitivity. Unlike China, which is a massive commodity producer, many EMXC nations, specifically India and Korea, are net oil importers. If geopolitical tensions in the Middle East cause oil to spike past $120 per barrel in mid-2026, these economies will face imported inflation that could hurt the stock market. The crowded trade risk. Because so many hedge funds have rotated into EMXC in the last 6 months, there is a risk that the market is currently being traded as overbought. A minor disappointment in Indian GDP or a delay in AI chip shipments could lead to a sharp 5 to 10% flush-out of latecomers. Comparison: EMXC versus the field. Before you invest, you should know your options in the 2026 market. EMXC, iShares, the most liquid option, best for those who want a blue-chip experience with very low spreads. XCEM, Columbia, a slightly different index that can sometimes outperform in value-heavy environments. VXEM, Vanguard, the newer entrant, very low cost, often used by those who already have a full Vanguard ecosystem of funds. FRNTR, Frontier Markets, for the truly adventurous. This includes countries like Vietnam and Kazakhstan, which are even earlier in their development than the EMXC group. Strategy: how to position EMXC today. In early March 2026, the smart money is treating EMXC as a core growth satellite. The 15% rule. Many financial advisors recommend using EMXC for about 10 to 15% of a total portfolio. This allows you to participate in the Asian tiger and Indian elephant growth stories without the extreme volatility of owning individual international stocks. The buy the dip marker. Currently trading at $88.20, EMXC has a strong technical support level at $82.16. If the market experiences